Hello and welcome. You're with us here on a fresh new edition of the Global Reset right here on CNBC TV 18 Prime. Well, what we're going to do today is get you the latest updates from the PMI report from S&P Global. It's a report which has been sort of put together by JPMorgan, and we'll talk to the chief economist at of this report to run us through the details in terms of what the report holds. This is Chris Williamson, who is the chief business economist at S&P Global Market Intelligence. So that's coming up in just a bit from now. Well, before we go any further, let me quickly get you up to speed with the news on the global front. Starting with a deal that pushed the Nasdaq and S&P 500 higher in Wall Street's trading session. OpenAI has signed a deal to buy $38 billion worth of capacity from Amazon Web Services, its first contract with the leader in cloud infrastructure. This is also the artificial intelligence startup's latest sign that it no longer is reliant on Microsoft.
OpenAI, the maker of ChatGPT, has signed a 7-year, $38 billion deal to buy cloud services from Amazon. It's the company's first big push to power its AI ambitions after a restructuring last week that gave it greater operational and financial freedom. The agreement, announced on Monday, will give OpenAI access to hundreds of thousands of NVIDIA graphics processors to train and run its artificial intelligence models. It underscores the AI industry's insatiable appetite for computing power as companies race to build systems that can rival or surpass human intelligence. OpenAI CEO Sam Altman has said the startup is committed to spending $1.4 trillion to develop 30 gigawatts of computing resources, enough to roughly power 25 million U.S. homes. The deal is also a major vote of confidence for Amazon's cloud unit, Amazon Web Services, which some investors feared had fallen behind rivals Microsoft and Google in the AI race. Those fears were somewhat eased by strong growth reported in the September quarter. Amazon shares hit an all-time high on Monday, with the company set to add nearly $140 billion to its market value.
Another story that made headlines earlier this week was when U.S. President Donald Trump announced that he had instructed the Defense Department to begin nuclear weapons testing. And the phrase he used was, and I quote, on an equal basis with Russia and China. The order to resume nuclear weapons testing comes after a gap of 33 years. How many nuclear weapon tests have been there, and why were they stopped, and why would anyone start them once again? Here's a detailed report to understand. It's a comment by the U.S. president, but then it's also something, I think, which the world needs to take note of. Here's the report.
3, 2, 1.
It's been 33 years since the United States last tested a nuclear weapon. U.S. President Donald Trump may end that streak after a surprise announcement made only minutes before meeting with Chinese President Xi Jinping. Trump said he's instructing the Pentagon to test the U.S. nuclear arsenal on a, quote, equal basis with other nuclear powers like China and Russia. But why did the U.S. ever stop nuclear testing? They were the ones who opened the nuclear era by detonating a 20-kiloton atomic bomb in New Mexico in July 1945. A month later, they struck Hiroshima and Nagasaki with atomic bombs to force Japan to surrender in World War II. Thus began 5 decades of nuclear tests around the globe. The United Nations says some 2,000 tests were carried out, with the U.S. accounting for 1,032 of them.
By negotiating a treaty to freeze the production of fissile materials for use in nuclear weapons.
That mostly wound down after 1996 with the Comprehensive Nuclear Ban Treaty. It forbids nuclear explosions by everyone, everywhere. Heather Williams is a nuclear weapons expert at the Center for Strategic and International Studies.
The last U.S. nuclear test was in 1992. This was largely driven by public outcry, the environmental impacts, the humanitarian consequences associated with nuclear testing, but also there was a growing international movement to do away with nuclear testing.
Russia ratified the treaty in the year 2000. Then in 2023, President Vladimir Putin rolled that ratification back. The U.S. signed it, but never ratified it. So what would testing do for the U.S., and why now? Testing new weapons would offer what any test can, evidence of what they can do, and testing older weapons would check if they can still work. And for the Trump administration, this may have been under consideration for some time. In 2020, The Washington Post reported that the first Trump administration had talked about whether or not to conduct a test. As to the timing, any U.S. test would be seen by Russia and China as a deliberate flex of U.S. power. Putin has said that if the U.S. resumed testing, Russia would too. While post-Soviet Russia has never held a test, days before Trump's announcement, they tested a nuclear-powered cruise missile, nuclear-powered autonomous torpedo, and held a nuclear readiness drill, all in the span of a week. Putin has also said a global nuclear arms race is already underway, and Trump has justified his decision by claiming other countries are already testing.
Other countries do it. If they're going to do it, we're going to do it.
However, Williams says a U.S. testing restart may help Beijing the most.
The United States conducted over 1,000 nuclear tests. Russia conducted over 700. China has done less than 100 nuclear tests. And a lot of Chinese experts and officials have pointed out that China might be at a disadvantage in terms of knowledge of its arsenal and weapons designs because it just doesn't have as much testing data. And so if the taboo against nuclear testing was broken, if there was a return to more nuclear tests, China stands to gain way more from this than the United States would.
The world once hosted some 70,000 nuclear weapons at the height of Cold War stockpiling in 1986. Now that number is closer to 12,000, most of which are held by Russia and the U.S. China is number 3, with a stockpile that has doubled to 600 in the past 5 years under Xi Jinping. All three are undergoing major modernizations of their arsenals.
Well, that's a sort of interesting report. Now, speaking of the three major powers, US, Russia, and China, let's also listen to a CNBC exclusive with Howard Marks, who is the co-chairman and co-founder of Oak Tree Capital Management, as he gives his outlook on the recent meeting between US President Trump and Chinese President Xi Jinping.
The takeaway is one of pragmatism, that these are two great powers, both of which possess great strengths, both of which need the other. And the other thing is that it's really important to realize that in its 80 or 100 years of primacy in the world, the U.S. has really never had a real rival in economic terms. We thought Russia, USSR, was a rival, but it was a facade. China is a real rival. It has great strengths, it has dynamism, it has rapid growth, it has enormous human resources and focus and purposefulness. So the U.S. has to learn to live with the strong, legitimate rival, but rivals don't have to be enemies.
Well, Howard also shared his views on the AI bubble and how he believes it could shape the market movement. Listen in.
We all, I think, are willing to grant that AI will change the world. Nobody knows how, when, with what effect, with what profitability, who the leaders will be. I think it's all a state of flux, and we won't have these answers. There may never be a terminal answer. The question that I get the most often surrounding AI is whether it constitutes a bubble in the markets, and it's certainly significant. It's certainly going to change the world. It certainly is popular and has been bid up. Very hard to know. You know, every movement in the markets is abetted by the words, it's different this time. There's no doubt that with AI, it's different this time. The question of whether the difference has been accurately gauged or overestimated, no one can say.
Okay, well, that's the news wrap as far as the global front is concerned. But before we go to our guest on the other side of a quick break, I want to show our viewers this package on manufacturing activity. Business surveys show that the world's biggest manufacturing economies struggled to fire up in October as weak U.S. demand and U.S. President Donald Trump's tariffs hit factory orders. Take a look at this report.
The world's big manufacturing economies struggled in October. That was the sign from business surveys released on Monday. Factory orders were hit by weak US demand and President Donald Trump's tariffs. The Eurozone Purchasing Managers Index, or PMI, showed factory activity stagnated as new orders flatlined and headcount fell. Export powerhouse Germany showed little sign of recovery as production growth slowed again. France's manufacturing sector stayed weak while Italy's contracted marginally. Factories had their strongest month in a year in Britain, which is outside the EU. But the recovery was driven by a one-off bounce from the restart of production at carmaker Jaguar Land Rover after it was hit by a cyber attack. Trump's visit to Asia last week led to some progress in trade negotiations with the region's large manufacturing economies. However, exporters are still cautious about US demand. PMI data showed Monday manufacturing activity in China grew at a slower pace last month while it fell in South Korea. Export orders in both countries also declined. Friday's official PMI survey confirmed China's factory activity fell for the 7th straight month. Analysts argue it suggests an earlier export rush to get ahead of US tariffs had ended. Trump and Chinese President Xi Jinping agreed to de-escalate tensions in a meeting in South Korea last week. It included a one-year delay in reciprocal tariffs. But analysts say the agreement does little to address a deeper divide between the world's two economic superpowers.
Well, let's slip into a quick commercial break here. We're going to talk about exactly some of this stuff with Chris Williamson, Chief Business Economist, S&P Global Market Intelligence, manufacturing activity in October, and how does it look as we go into the end of the year. Coming up. Welcome back. You're with us here on CNBC TV in Prime. You're watching the Global Reset. Now, the latest JPMorgan Global Manufacturing PMI compiled by S&P Global shows the world still walking the fine line between resilience and slowdown. Manufacturing output and new orders are expanding for a third straight month, but optimism has slipped to a sixth-month low, and trade remains weak. Joining us today on this show to talk about this report is Chris Williamson, Chief Business Economist at S&P Global Market Intelligence. I'm going to decode the October numbers. Chris, great to have you with us here. Thanks very much for joining us. I mean, the report notes that the global PMI remains an expansionary zone, but optimism is fading. So there seems to be a wide gap between, current conditions and future sentiment. Let's just start there, Chris. But this also kind of seems natural, isn't it? 6 months back, expectations were there by H2, the U.S. economy, particularly the U.S. economy, and consequently the world economy would slow down materially, which has not happened. So I guess people are still waiting for some of that to show up.
Indeed, yeah. There is this interesting divergence between steady growth, unexciting growth at the moment, but at least it's growth in the manufacturing economy, and deteriorating expectations about what's likely to happen in the year ahead at factories worldwide. I mean, the picture in October itself, in terms of output growth, we're signaling production rising at an annual rate of around 1.5%, which doesn't sound too fantastic, but in the context of the last 3 years, say, since the pandemic, in which manufacturing's had quite a tough time, this is one of the best spells of growth that we've had. But when we look at see what's been driving that, there's a lot of temporary factors there. There's been this front running of US tariffs. So a low point was seen back in April when the US announced its new global tariff scheme. And since then, we've seen production and trade flows rise as companies try to get ahead of those tariffs, exporting to the US factories, buying large amounts of imported inputs. And this seems to be rolling over now. We're over the peak of that. Companies are sensing that the influx of new orders coming into them are starting to disappoint. The customer demand, which they thought was there, was a bit of a mirage. It was this tariff front running, and now that's fading. And so they're starting to get increasingly pessimistic about their own output in the year ahead, to the extent that in October, while sentiment is better than it was back when the tariffs were announced back in April, it's amongst the lowest for 3 years now. So while current output growth is amongst the strongest over the past 3 years, those sentiment aspects are the gloomiest that we've seen. And it's all to do with these tariffs and how their business cycle is responding to those. It looks like we're starting to see some weakness come through in some economies there.
You know, in the so Asia is doing okay. US is leading the growth. I mean, Asia ex China and US, whereas China and Europe are lagging, right? So even when you look at some of these manufacturing cycles, I guess there is so much going on, right? Recalibration. There's all this industrial policy and a lot into the mix there, Chris.
There's an awful lot going on. Yeah, you're right. US and Asia as a whole is leading the growth. That US growth, though, we're worried about that being sustainable because having bought all these imported inputs in the second quarter of the year, trying to get ahead of the tariffs, factories have been sat there thinking, well, what do we do with all this stuff? We might as well make stuff. So they've been producing their final goods with these inputs, but they've not been selling them. So we've ended up in recent months with the largest accumulation of unsold stock at US factories that we've ever seen in over 20 years of data collection. So this suggests that their full warehouses of unsold goods, they're going to maybe pull back on their production in coming months in the US rather than increase it. So US, while it's good at the moment, leading the pack in the developed world anyway, its future prospects look a bit darker. In Europe, though, for example, while there's a lot of focus on just how weak the PMI is there, at 50, the break-even zone between growth and contraction, European manufacturing's had a really torrid time since the pandemic with the high energy costs associated with the Ukraine war and so forth. To be stable in Europe is actually not a bad picture that we've seen compared to the last few years. And inside the Eurozone in particular, you've got really nice pockets of growth coming now from the economies like Spain and Italy and indeed Germany. These are starting to show signs of life as domestic demand in Europe is starting to pick up. You're over the energy crisis, you're over the cost of living crisis, interest rates coming down. European manufacturers are starting to see some pickup in domestic demand, and don't forget more fiscal spending is coming through, notably in Germany. That's helping offset some of the impact of those US tariffs, which are dampening exports to the US from Europe. Meanwhile, in Asia, you're also getting companies responding to the threat of US tariffs by shifting the trade routes. So you're getting more intra-Asia trade. And we've got some really nice pickups in countries like Thailand and Vietnam come through, where we've got multi-year highs in the PMIs as exporters are really starting to pick up pace again. There's some intra-Asia export trade there, but alongside that also there's this diminished concern about the US tariffs. Back in April, there was this great fear that we're going to see these horrendously high tariffs, but those fears are starting to dissipate now a bit. So that's helping revive manufacturing conditions a bit in parts of Asia. So I'd summarize really by saying that while the US is doing well at the moment, I'd suggest that its future prospects are looking a bit darker than maybe in Europe and parts of Asia, where perhaps the outlook's brighter than it has been for some time.
Yeah. Export orders are, I think, they're contracting. This is the 7th month of contraction, right? Globally, yeah. So some of that, what you described, basically going on and showing up in these numbers, Chris. Input costs have eased, but firms continue to raise output prices. So how does one explain that, Chris?
Yeah, so from the price scenario, it's actually quite benign globally, inflation. Yeah, input costs are rising globally, and this is feeding through to higher selling prices on average. But both of these rates of inflation globally are broadly in line with the averages that we've seen over the past 2 years, which itself has been really, really benign. The global inflation environment that we've had since the pandemic has been generated by the service sector. Manufacturing has been largely disinflationary. It's not been the problem that policymakers have been facing. It's largely the service sector that's been driving those global inflationary pressures. And that looks like it remains the case on a worldwide basis in October. But there is a notable exception here, and that's the US, where we have got high input cost inflation, very elevated by historical standards. Not the same as during the pandemic, but it's certainly not consistent with the central bank's 2% target. It's pushing higher. Output prices, that's feeding, they're rising in the US on the back of that as well at a more elevated rate than elsewhere in the world in most economies. But it looks like companies are struggling in the US to push all of those input cost increases through. Now, those input cost hikes are invariably being blamed on tariffs, high import tariffs raising their costs. It looks like US companies are struggling to pass those higher costs fully through to their customers. They're getting resistance on prices. This is both from the business customers as well as, in particular, household customers, the consumer markets. They're getting price resistance there. And whereas they seem to have more success earlier in the year passing those through, getting more pushback now. So that's certainly an indication that there may be a bit of a profit squeeze starting to bite in the US now.
Got that. Just last question here. With employment flat despite production gains, Chris, are we looking at the early signs of higher productivity? AI is a factor which is, of course, discussed, but no one really at this point is sure how much of this is can be put at the doorstep of AI, or this is simply corporate caution ahead of 2026.
Certainly, yeah. So whereas we've got output growth globally at the moment, there is no employment growth. So that's suggestive of companies focusing on productivity in this uncertain environment with their caution about the year ahead. They're not taking on staff. Instead, they're trying to get more out of their current workforce to try to just protect themselves and generate more profitability. There are growing reports of companies saying, look, we just don't need as many workers now because we are starting to see the benefits of AI. That's starting to come through in the anecdotal evidence from the surveys. And this is across the world that we're seeing this. It's very small impact at the moment, but it's there. It wasn't there a year ago, but we are now seeing companies saying, yes, AI is helping us in terms of what our staffing needs are at the moment. So that's starting to come through. It's a factor, and it's suggestive of increased productivity. That AI also, globally, we're also seeing this starting to affect the investment spending patterns, whereas we've got definite signs of strong growth in tech-focused industries, but less growth in the traditional machinery and equipment manufacturing. It looks like that CapEx spend side of thing, the more traditional CapEx spending, is not seeing anything like the growth we're getting in the tech side, which is obvious. But we do really need that more traditional tech investment spending on traditional goods, machinery to come through to really generate a more sustainable looking upturn. And it's just not there at the moment. If companies are spending any money on investments, it's going towards the tech side, the AI side, at the expense of the other forms of fixed capital investment.
Yeah, got that. Chris, lovely conversation, and good to get some of that perspective on the report for the month of October, and I hope we can have you back as we continue to track how the global economy does. For now, there is expansion afoot, even though there is a fair bit of divergence beneath the surface. Well, it's a wrap on this edition of the Global Reset. Thank you very much for staying with us. More coming up on CNBC TV 18 Prime on the other side.